Today our class is focused on basic tax. There are many different types of taxes in South Africa, such as the VAT, the value added tax, employee tax, donations tax, dividends tax, capital gains tax. Our class will focus on the tax we call the normal income tax. The normal income tax is the tax paid on the company's profit, i.e., if an item is recognized in profit and loss, then the tax thereon must also form part of profit and loss. If an item is recognized in other comprehensive income, then the tax must be recognized in other comprehensive income. The tax expense will be disclosed as an item in the statement of comprehensive income. But how do we pay tax? Companies are required to make 2 provisional payments of tax during the year. A third top-up provisional payment is made if the 2 provisional payments are significantly lower than the expected final tax charge. These payments are based on estimates of taxable profits for the year. So the first provisional payment is made within 6 months of the beginning of the year, calculated at half the amount of tax the company estimates it will owe for the full year. So how do you generalize it? You have to debit current tax payable on the statement of financial position and credit bank. Then the second provisional tax payment is made within the last 6 months of the financial year, but no later than the last day of the financial year. So how do you calculate it? You say total estimated tax for the year less the first provisional payment. So the estimated profit for the year used to estimate tax will generally differ to the estimate used for the first provisional payment. The journals will be debit current tax payable and you credit bank. And then you have to do a final assessment. So after the company has finalized its financial statements, it submits the returns to SARS. SARS assesses the tax due to the company. When it assesses the tax due to the company, it debits tax expense and you debit tax expense and you credit current tax payable. And then how do we pay tax? So the final tax assessment, if SARS assesses the amount of tax to be greater than that provided for, an under provision is said to exist. If SARS assesses an amount of tax less than that provided for, an over provision is said to exist. An under provision or over provision is accounted for in the subsequent year as the financial statement has already been finalized. So you debit tax expense in the statement of comprehensive income and you credit the current tax payable. Under provision, a journal in the subsequent year is an inverse of over provision.